Gautam Duggad, the Head of Research Institutional Equities at Motilal Oswal, joins us now for a quick check as to what should we expect for the earnings season. Gautam, hi, good morning. Thank you so much for making time and speaking with us. That's exactly my first question. Given the fact that India is already trading at quite a bit of premium to its historic valuation, at the end of this earnings season, do you expect that the valuation will only expand due to EPS downgrades, or do you think earnings will catch up?
Hi, good morning. Thanks for having me. Actually, I don't agree that India is trading at a substantial premium. If you look at Nifty's 1-year forward PE, it is 19 times. And if you look at long period average, which is the 15-year average of Nifty, it is at about 18.5, 18.6 times. So we are bang in line with the long period averages. So it's not correct that India is trading at a substantial premium versus its averages. What is, however, happening is, because the other regional emerging markets have seen derating, India's premium versus emerging markets has expanded to an all-time high. So if you look at MSCI India versus MSCI emerging market, our price to earning multiple is now at a 141% premium versus a 10-year average premium of 65%. But on its own, if you look at absolute valuations of Nifty, it's not at any meaningful premium because last 1 year we've been flat. But the fact remains that most of the other global markets are down 15 to 25% and we are flat. So India is standing out like a shining star in an otherwise very volatile and very headwinded environment globally. As far as where the valuations can head, I think India's earnings picture is very solid. So why we are trading at such a substantial premium versus emerging market, I think is for 2 or 3 reasons. One, our macroeconomic management, whether it comes to interest rate, currency or bond, has been very prudent and judicious when you compare it with other global central bankers which are in a panic mode. Second, the relative earnings of India has been extremely strong. In the last 2 years, our earnings are up 60%, and this year our expectation is about 11-12%. So earnings picture is also better versus other markets. And our macroeconomic management, I would think, is slightly better versus most of the other global central banks. And third, of course, the flows, the domestic equities inflows have been very robust. I think many of these things can continue as we move forward in FY23. The only joker in the pack, as always has been for India, is the crude oil prices, which have again started going up after the OPEC decision. I don't expect any big downgrades, so to say. There are some downgrades which have already happened given the disruption in global commodities. So we have also cut our numbers by about 3%, entirely led by metals and oil and gas, which has driven our EPS estimate down from 840 to about 820 rupees now. But the entire cut is from oil and gas and metals. Rest of the market, which is financials, auto, consumer, is looking pretty okay.
Enough. So Gautam, just to stretch that point forward, you were talking about, an improved outlook when it comes to the earnings going forward. Given the fact that by and large, the kind of operational updates that we've got have been fairly encouraging, there have been a few blips, if you will, or acknowledgement of inflationary pressures when it comes to the FMCG sector. So if at all you are likely to see some sense of margin erosion or an impact on earnings coming in, which sectors would those be in?
So, like I said, this quarter is going to be a bit tricky on optics because if you look at reported numbers, you might see earnings being flat for Nifty. And as far as our coverage universe is concerned, we are estimating a 17% earnings decline because we are building in a 60% profit decline in metals, 90% profit decline in oil and gas, which is largely coming from big losses in OMCs that we are expecting this quarter. If you keep aside metals and oil and gas, for both our coverage universe and for Nifty, we are expecting a solid 30% earnings growth. As far as your point on margins for consumption sector is concerned, you have to look at it in 2 ways. This quarter, your margins will still be under pressure because the fall in commodity prices, whether it is palm oil or crude, will get reflected in the P&L from third quarter onwards. So this quarter, you will still see consumption of higher priced raw material, and which will take its toll on the operating margins. But I think market will look beyond that because the commodity prices post June, July have already corrected. Now, how much of it gets reflected in the P&L in second half of FY23 is a function of what extent of this commodity price cuts get passed on to the consumer through price cuts, because most of the companies would want to gain market share, would want to expand their volume growth. So it will not be a linear sort of a flow through to the operating margin. Some of it will get flowed through to the P&L. Some of it will benefit consumer through lower cost. But all in all, whether it is a consumer sector, auto sector, cement, and some of the other sectors, the margin picture will look far better starting third quarter FY23.
What's the individual expectation from banks and IT? And I purely ask because of the high bearing and weightage that they have on the markets.
Yeah, so banks, we are quite positive. We've been positive for more than 3 years now, and it's a shining star. I'm very consistent as far as earnings is concerned. We are again expecting about 36% earnings growth this quarter from the entire financials cohort, within which our expectations for private banks is about 53% profit growth, 26% for PSU banks, and 20% for NBFCs. What is also happening concurrently is the credit growth has started picking up, and we are at about 16%, which is a 9-year high. Credit cost has come down significantly in the last 4 years. In fact, if you look at the earnings trajectory of financials in the Nifty, there are 11 financial companies in Nifty. In FY18, their profits put together was 45,000 crores. In FY22, it went up to 1.5 trillion. And this year, we are expecting about 1.95 trillion. In fact, in this quarter, our earnings have been upgraded by 2% for financials. So this remains a very consistent and a strong story on earnings. The second sector you asked is IT, where obviously there is a difference in the commentaries from corporates versus what is the prevailing macro narrative, where you are seeing recession concerns in US and Europe, rates going up and currency all over the place. But a corporate commentary from IT companies as late as 2 weeks back at our 18th annual Global Investor Conference was quite healthy, where we are seeing corporates across the board in IT sector talking about consistent demand and supply pressures at the margin moderating, with attrition going to come down as we move forward. However, markets will take its own time before they start believing in this, because there is a clear disconnect between what the companies are saying and what the macro is telling you. From a valuation point of view, they are down 30% on a 12-month basis from the peak that we saw last year in October. So we are finding value in large cap IT, and which is why we are keeping our overweight stance intact there. And of course, ROE, free cash flow conversion and payout metrics are best in class across the sectors that we cover in India for IT sector.
Thanks so much then, Gautam, for joining in, giving us your outlook on the overall macros, the earnings growth, as well as where you're seeing value in the markets. Just a quick check-in.